Hello and welcome to Gamma On, where we're taking your trading to the second derivative, talking options in all their forms, and also how it overlaps with major themes like technicals, trading strategies, all kinds of stuff we're going to hit. But today's going to be a little bit more nitty gritty. We're going to get into the actual calculations of determining gamma levels. I'm joined again by Shane Skinner, manager on the institutional trading team at Charles Schwab. Shane, what's up?
Not much. It's exciting times in the market right now, and I think just further evidence that this is the type of stuff that we should be exploring and talking about and educating ourselves on. So,
all right, tell me what we're in store for today. What are we going to be talking about?
So I guess just, summarizing previously, right, we ran over just the concept of gamma itself, delta, vega, theta, the first order Greeks, right? And then we sort of got into the nitty-gritty about liquidity providers, various big players in the market who are there to take one side and provide fills for people on the other side, and sort of how those Greeks affect the way those liquidity providers have to manage their books, right? So we established that. Today we're going to get into more so the concept of gamma exposure as a whole, sort of explain that, then move into how do we calculate gamma exposure, both on a strike by strike basis and then as a net as a whole. And then we're going to, again, remind throughout, why does this matter? How is this relevant? How is this possible?
Yeah.
And then give some visualizations and maybe even toss in a few ways to look at that kind of stuff. And
we're going to also use some examples and specifics from moments in the market. Obviously, we're pre-recording this, so people are going to have to kind of understand that these events have passed by the time they've looked at it. But we're going to take some screen grabs of live market data, just as a kind of a way to show the process for actually defining these areas.
Right.
And how you can actually do it on your own. A lot of this stuff is available publicly. You just have to know how to run through the numbers.
And using the Thinkorswim on-demand feature, you're able to go back and trade any historical day for the most part within our set of data. So that's the best part about this is after we've established how you can calculate this stuff, you can go back to certain days in the market that we either didn't move or we moved a lot or just weird days, right? And
so we're going to be talking about those days, screenshotting them, but trust and verify.
Yeah, exactly. And you have the ability yourself to go back and look at this stuff and sort of simulate what you'd see on any given day.
Well, I think today will be good because a lot of people still, I think, consider these sort of theoretical concepts that are, kind of for the first time, viewer or listener or trader who's kind of exploring those second derivative concepts. They can feel a little bit kind of wishy-washy, like out there, but it's just numbers, and we're going to run the numbers. Last time we talked about some analogs for the whole theme of this discussion podcast, which is the power of market makers, the power of big options dealers, and those who are accumulating a lot of flow in the market, who are responsible for a lot of volumes in markets, how that kind of establishes guardrails, these kind of vortexes of liquidity that can create these fulcrums, these turning points. It's something that we talk about basically every day on the Schwab Network in our options block and at the opening bell. The guy who usually does that is Mr. Kevin Green. Shane Skinner, you also jump on with us to do the same. But for those who don't realize, it's a fixture of our coverage. That's why it's very appropriate to bring in the one and only Kevin Green, a.k.a. KG, senior markets correspondent on the network, and someone who I think was one of the earliest people that talked to me about this stuff. Kind of, I think it was back at like the first Schwab Impact. We were drinking margaritas, and I was like, "Holy cow, this guy is like super in the weeds." KG, thanks for being here on Gamma On.
Appreciate you having me. I think I was actually having a Budweiser, the margarita guy though.
Yeah, you might have had the Bud. I think I was probably on the marg after doing the shows from Impact all day. Hey, this is right up your alley, obviously. We talk about this stuff on air basically every day. You listened to our first episode. I wanted you to kind of start us off with your input on the big picture, why we're talking about this stuff right now, sort of how and why it's become popularized, and also any feedback on what we've discussed so far.
Well, when we talk about gamma exposure, I think it's really key to note that it's a theoretical value regarding the potential risk or exposure for an options delta, either to the upside or downside. And this is actually very important when you are a market maker or a dealer that's transacting in a fair amount of options positions in a given day. So what we try to look at is the confluence of positioning, basically large blocks of orders and or a large amount of open interest at a certain level that could lead a market maker to be exposed either to the upside or downside and may cause them to react if the price of the equity or the index gets close to their strike price. So that's really why it is key. And then what we look for is open interest that is very large. And we try to net out the positive gamma, which is basically kind of focusing on the call side, and then the negative gamma, which is really focusing on the put side at that particular strike. And when we net those out, those large net numbers, if you're looking at positive or negative, could be areas of resistance or support, similar to how we kind of look at RSI or CCI from a technical analysis standpoint. So it's not going to really tell you the direction of the market, but it could give you an opportunity to identify areas of support or resistance in a market where we might have traders really trying to buy up in an area of support or try to sell the market at an area of resistance. But we always have to just kind of keep in mind, this is all theoretical, and we're making the assumption that all calls in the market are being sold by retail traders and institutions, making those dealers long those calls, and all puts are being bought by retail traders or institutions, making those dealers short those puts. And so if you're short a put, if you're a market maker, your exposure is to the downside. And if you are long a call for a market maker, your exposure is actually going to be to the downside as well. So we can have compressed markets, we can have expanding type of markets, and that's really what we're trying to find, that confluence between open interest or a particular strike price, and then trying to mirror that or match that with a certain level on a chart, whether it's a support area or resistance level.
I think that's where there's a lot of the technical overlap too, where it's like there are certain indicators that like super sophisticated technicians use, and there's like spectrum of like how popularly known things are, and oftentimes the ones that are the most popularly known are the ones that are carrying the most weight. There's also certainly some truth that we see in our coverage on a daily basis that a lot of the gamma stuff does end up overlapping some of those levels with kind of traditional, just kind of eyeballing technical stuff sometimes. KG, you mentioned something I want to come back to, which is risk exposure, and really that's what it comes down to. That's a really good way to summarize it from the perspective of the people who are really moving this much volume, is that that's kind of why these can become fulcrums or sort of flip points, because risk can change. But the idea is that these participants generally are pretty well defined in their risk, and so there are oftentimes lack of a move more so than a big move. But that's why the potential for the big move's there.
Yeah, definitely. So when you're talking about a market maker, there's this misconception that a market maker is pretty much on one side of the market, and that's really not the case. Their goal is to be delta neutral as much as they possibly can, meaning that they have exposure either to the upside or downside. They want to actually be in a place where it really doesn't matter. I mean, they make money on time decay. If you're talking about an options market maker, that's really their key bread and butter and how they make money. And if we have more transactions, more volume taking place, they're making more money off of those spreads. That's how they actually run their business. But when you look at the exposure either to the upside or downside, that excessive risk or potential risk that is out there, that's where these second derivatives come into play. So if you're talking about gamma, as Shane was talking about in the last segment, if you will, gamma is that change in delta as price moves to one way or another. Okay. These second derivatives, though, and I think this is very, very key, gamma risk cannot be fully hedged in a market at all. That's what makes options options. Volatility risk, or if we talk about Vanna risk, that cannot be fully hedged.
Yeah.
So that's where you actually have these breaks, these melt up in the markets, these gamma squeezes, or these complete IV crushes. It's just something that we are just not able to be able to hedge. Market makers are not able to hedge there. And if you have somebody or a lot of retail traders or institutional traders on one side of the boat, and you have a product or a stock that kind of moves in that direction, let's say that you have an option, a call option, and the stock continues to rise, that market maker that's on the other side of that call option, they're short those calls, they have that upside risk. And as that stock continues to move higher and higher, the risk can actually continue to grow. In order to hedge that risk, they either need to take action in the options market, maybe selling downside premium, and or they need to go into the stock market and actually buy. And that's how you have these domino effects, which is what I really call it, either melts up to the upside or downside. So that's the key reason why I focus on gamma levels. Yes, they're good areas of support resistance, but it also signifies the risk that cannot be hedged in a market and why we can have these strong catalyst moves in a breakout or a breakdown scenario.
To that point, I got one follow-up on that, and it might be a little bit speculative and perhaps just an impossible question to answer, but I'm curious about both your thoughts on it. First, KG, and then Shane, which is when you talk about how you can't hedge fully gamma, right? It's the same. I mean, at a very basic level, it's sort of the notion that stocks generally trend upward. This is from a very basic, just taking it back to kind of a linear, I'm long equities. Then the only stuff that really breaks a trend are these kind of like black swan events, these sort of high volatility events. Now, obviously, there's a spectrum of volatility, but I'm curious if you think any of the options proliferation then lowers the bar for what kind of outside exogenous effect is required then to have a pretty notable swing. Do you think this does create shorter term opportunities that don't need like major outside like exogenous black swan events then? Does that make sense, KG?
Yeah, a little bit. So, let's kind of, unpack that just a tad bit here. So the market generally, as you kind of talked about, trends to the upside. And so when I talk about market makers trying to be delta neutral or they have a very small skew, their small skew is also to the upside. And the reason is because of option structure. If you're looking at a curve of implied volatility, you generally will pay more of a premium for downside protection. You pay more of a premium for puts than you do for calls, right? Just in general. Now, every once in a while, you can have a stock that's just on a run, Carvana being one of them recently, right? That continues to run.
Squeeze to the upside.
Yeah, and you have more call side skew. But generally, puts are actually more expensive than calls are. And so if that is going to be the case, the selling of puts from market makers, they're making the premium up for the upside move in a call or in any type of equity, if that kind of makes sense. So they're naturally going to be long the market. It just depends on how quickly that market actually melts to the upside. That's it's all about time. And that's the thing that cannot be hedged is time and volatility. That's why we say gamma cannot be hedged. Volatility cannot be hedged. Charm, which is going to be time risk, really cannot be hedged because at the end of the day, these are decaying assets and that's just inherent in their nature.
It's a really good point that I think emphasizes that the gamma effect on volatility, I think, becomes more specific to gamma as a catalyst, as sort of a feedback loop when it happens to the upside. Because then you get stuff like, stocks up, VIX up, you get some of the memification, some of those squeezes, those type of events. Whereas a lot of times when you have downside risk, that is sort of a macro outside force that doesn't really need to be, can it be accentuated by dealer positioning? Absolutely, of course. But I think the stuff, because my question is really, how do we determine gamma as a catalyst and second derivative functions as a catalyst versus the exogenous kind of typical equity outside catalyst as risks? And I think that KG does a really good point of pointing out that I would argue then it's when there's upside squeeze, basically. Jump in, Shane. What do you think?
I mean, yeah, I would say that it can be present in both scenarios. And I think, we've said it before. I think Kevin would agree that it really comes down to positioning. It's all about the relationship between liquidity providers and the rest of the market, retail, institutional, whoever that's on the other side of the market is whoever's providing liquidity. And it's the market moving is the fulfillment of the decision making that takes place on both sides for the liquidity providers to say delta neutral if possible and keep everything from falling too far from one side to the other. And then when does retail, institutional, whatever, move their positioning? Because it's as simple as if everybody just goes and buys calls and the only thing that the liquidity provider can do is buy the underlying up to hedge because nothing else is going on in the options market that allows them to hedge the other way. It's very one-sided market, right? This whole side took long calls and then this side to hedge that as those calls sit there, they've got to buy it up. But again, these things like time, these things like change in vol, things like that create an effect on the deltas. So eventually, like, it's almost kind of like stacking.
Yes.
And then eventually, you stack too high too fast, it's very possible you can come back down as quickly as you went back up, because if the juice is gone, the run up is gone, those market participants that bought those calls, they got to sell them now, right? They got to cash in. And if they don't, maybe it slowly comes down, but as they start to pull that off, that actually puts a positive delta effect on the liquidity provider's book, which then in turn, well, now they're long all this underlying that they had to buy up originally to hedge. Now they've got to sell it back off to hedge it back in the other direction as the market participants take the other side. So it's the self-fulfilling thing. And
for sure, that can happen in both directions.
Correct.
By the way, this is literally what we're charting every day with positive gamma levels, negative gamma levels, where these things kick in. I guess the kind of, again, this is sort of like a philosophical point to some extent, but I feel like we could also measure it too. It's just, it seems to me that the options exposure as a catalyst itself, because that's what is so important about the way we're talking about these things, is because you have market risks, and then you sort of have the actual feedback, the tail wagging the dog thing, which I feel one could argue, that I guess I am arguing, is that it happens on the upside. We can attribute it a lot of times to this type of stuff. Whereas on the downside, I feel like we are going to end up oftentimes attributing it to outside forces, just like something bad hit the tape or something. Shane and KG.
I think, yes, there's usually something when there's major negative gamma, a lot of put buying and not a lot of positioning elsewhere in the market. I think, yes, that usually has something you can pair it to in terms of news as to why. Again, it's almost like, what's the theory or the philosophy behind why people put the positions on they put in the market. If you have a meltdown and in that situation, a ton of put buying took place. Okay, what caused the put buying? What drove the put buying? So it's again, I think it's all sort of intertwined. It's really just like what drives and motivates one side of the market to do what it does, and that's the retail and the actual participants, the institutional, I should say, the liquidity providers, market makers, dealers, stuff like that. We sort of know what they're there to do, and we know how they kind of have to do it, right? It's not
the
like
game theory is not super complicated,
right? No.
You got a bunch of positions at a spot. If it goes through, you're going to have to cover yourself.
Yes, exactly. And so by knowing this side of the equation, it's sort of the random variable is more, what are we doing? And based on what we're doing, they're simply responding, and the market moving wherever it moves to or doesn't is a fulfillment of all of that.
Yeah, for sure. KG, as we're talking like the directional stuff, go ahead.
Yeah, I do want to highlight something though, because this is very important when we kind of talk about these levels, gamma exposure, and the possibility for massive rips to the upside or dips to the market. A lot of retail traders are still only long buyers. Okay, so we have to keep that in mind. You usually don't see as much aggressive put buying in a market as you do put call buying.
For sure.
Right? There's a lot of retail traders out there that say, I'll buy the calls. I can understand the calls, but I'm not going to really get into the puts. And then they're a little bit concerned because, okay, if it goes in the money and then, I don't do anything with it and I'm going to be short this position. So you never really see as much of an aggressive put buying environment that outweighs the call buying that we see on a historical basis.
I think that's going to skew it.
Yes, so I think that's one thing to kind of keep in mind. One, two, you have positive flows, index flows every single day, and so over time the market should continue to rise just by the power of money, right? The exponential power of money. So there's always going to be that upside, and then when you're looking at downside risk and puts especially those that have size, and Shane can kind of talk to this because he obviously deals with these individuals on a daily basis. They're usually collaring a position. A big institution that's putting on a 5,000 block or a 10,000 block order for options is usually actually collaring a position. You usually do not see an institution, there's some, but not a lot of them, that are going out and doing 10,000 contract blocks in order to scalp a downside trade. Because a lot of times they'll be the majority of the volume for that day.
It's
They're going to be up
expensive.
against a market maker. Yeah. So usually what I would say is when you have these downside breaks and we're in negative gamma territory, meaning that dealers are off sides and their exposure is to the downside. And the only way for them to be able to hedge that position is either to take action in the options market and continue to sell excessive premium and or short futures, if we're talking about the index level and just in general. Usually those pullbacks, Oliver, are very swift and quick. Those aren't the ones that melt down and they're getting pressure for a month and a half, and just accept. That's not options doing that. That's people that are long stock and selling those stocks
That's
out.
the exogenous event basically causing panic.
Exactly.
Yes.
Exactly. The
Great
swift
analysis.
breaks of 15-point moves in a matter of 2 minutes, 3 minutes, those are the options that are kind of taking place there. So those are the two different dynamics.
That oftentimes are the quickest to recover as well, generally, because they're kind of they're going off of the trend essentially for the most part. They're kind of mean reversion opportunities generally. I think that's an important clarifying point and a really good perspective on how some of these dots connect, because there also is just there's a lot of people who will kind of take the cheap shot at the options proliferation and say, these are like some negative force, and they come up with like this sort of like boogeyman story that just, it doesn't make sense, because if these players are as financially motivated as there exist in the world. So like, I wanted to kind of go through that process so people understand the causality to some extent. All right. Also, the importance that I think the kind of gamma skewed generally in terms of it as a catalyst. For me, gets more interesting when it's to the upside. I mean, think about it. That's where the fall up, stocks up environments. That's when things get really interesting. You get these squeezes where if enough people can push, on a lever like they did with GameStop to a certain extent. So that's where I kind of find it more interesting. Whereas a lot of times if we're talking about like downside moves, if they're big monumental moves, it's because of outside force. Tell me, 60 seconds from both of you guys, kind of how you either start the day thinking about this or your process. Shane, start us off.
Yeah, I guess first thing, and I'm sure we'll get into
tell us
this
like how much yogurt you eat in the morning, but like, when you're sitting at the desk basically and you're like combing through the market.
Yeah, no, so when I get in the morning, the first thing I do is like hop on, I start looking at open interest levels. And then once the market opens
S&P index,
itself,
SPX?
yeah, SPX typically,
Okay.
but that's where you see a lot of notional risk.
Of course.
So basically, you look at those levels. Once the market's open, we're taking our formula again that we're going to get into in a bit, and we're calculating out the levels, and that's updating in real time. And so as the day goes on, initially, you sort of get a nice little initial, okay, this is sort of what we're working with.
You got to wait
today.
till the market opens, right?
Right, obviously. Yep.
course,
Yep.
yep.
And then based on that open, you have a quick roadmap of where levels we might need to look at are on the day.
And you're recalculating that every day, right?
Yes, because
What
it's
if the futures run change and we
expiration.
open? It still doesn't matter, right? Because positions.
Oh yeah,
change.
it doesn't matter. The whole point of the calculation is really just analyzing that day, open interest, relative to where the market's trading and what gamma is at each strike. And the idea is that basically, and I'm sure Kevin will back this up, right? Gamma increases the less time. There's more gamma. There's less vol. That doesn't mean vol doesn't exist on the front end, but that's gamma amplifies the closer to expiration you get.
Okay, yeah.
So to look at the 0 DTE, not only are we seeing 50 to 60+% volume that
get a lot
day,
of stark
you're also seeing a
information.
lot of open interest. Right.
Yeah.
So and that's
It's like the laser version.
the liquidity
Looking at the 0
providers, they've got to hedge tomorrow too. They do. But they have to hedge today.
gotta
And
get
if
through
today expires,
Yeah.
then that's a constant thing that's sitting there, and they've got to look at it and make sure it's under control, because at the end of the day, it's done.
Right.
And so that's why so much emphasis sometimes can be put on the front end are these 0 DTEs.
And then the process you're doing actually to pull the stuff, we're going to get into in real quick in a second.
Yep.
But you're also going to show us how another source, their version of it looks. KG, what's your prep looking like? I mean, we hear you right at the opening bell basically every day, so I kind of already know the answer. But for those that are unfamiliar or want a little, behind the scenes, right before that hit that we do at the opening bell, what's your process for getting all this data?
Yeah, so I pull 2 scans. So the first scan is going to be the open interest in the morning. So you're looking at across all of the expirations that are out there, and then you're looking at these gamma levels as soon as the market opens, and that's pretty much what I highlight on the chart. I actually go through the top 3, so I go through whatever has the positive gamma level, meaning that there could be an area of resistance. I go through whatever has the negative gamma area, which is going to be the area of potential support, and then there's like an intermediate one that I kind of highlight. It's kind of not really prevalent for others that really talk about it, but I actually look at whatever is near at the money, and you can look at the futures. You can look at the futures and see what the implied open is going to be for the S&P 500. I won't drill down into that, but basically
Sure.
I utilize that level as an intermediate area that's building up. Now, a couple of things. SPX does trade 24 hours a day. There's a very slow volume in the in the 24-hour session until we get to the equity open, but you do see a lot of institutions that start layering on their hedges at that time. So I do take that data into account. And then the last thing I do want to make sure that and then I also look at the volume. The volume one is just what's happening today.
Yep.
Yeah, whatever happening today. And I think that's actually more beneficial for intraday traders or scalpers out there rather than looking at open interest. Open interest kind of gives you, here's your big guardrails, and then the volume side kind of gives you the nooks and crannies of, okay, here's where I can scalp, here's what I can do. Yeah, I just want to make sure that we are all on the same page here when we talk about this. This can be calculated. We are taking a lot of assumptions in this calculation, and Shane will talk about this in a second. You're assuming that every call that's out there that's being traded is something that's being sold by a retail trader or an institution, and you're making the assumption that every put out there is being bought by an institution or a retail trader, which is not obviously the case, but that's been the benchmark that a lot of individuals that utilize this stuff use. So there's the theoretical aspect that we talk about, and then there's the practicality of, okay, well, not everybody's buying or not everybody's selling, but if everybody looks at these levels the same way, then it does have an impact, just like everybody looks at the 200-day moving average and says, okay, we all have to keep our eye out on it, even if you don't really believe in that average for whatever reason.
It's a good point that it is, right, we don't know which direction a contract is necessarily changing hands specifically, but if we all sort of zero the scale at the same assumption, which is also, even before kind of this stuff became super popularized, is just the way, with the kind of the baseline we had to have to think about skew and stuff like that, right? So that's a very good point. It's a good reminder too. Thank you, Shane. Thank you, KG. We're out of time for episode 2, but we've got a lot more ahead of us over this entire limited series, and it's going to be a pretty fluid discussion. So episode 3, next week, we're going to pick up right where we left off, which is going to be with actual calculations of gamma, going through the process of getting the data, sorting it, calculating, doing a little bit of math, doing a little bit of Excel. So be ready to follow along, bring a pen and a pad. All that's going to set us up for deeper conversations about how to use this stuff. We're going to be talking with professional traders and some of the best people that that are familiar with this and have been pioneers in this category of trading. So thank you for watching. Be sure to subscribe to the Schwab Network YouTube page. I'm Oliver Renick. Thanks for listening or watching Gamma On. Got a lot more ahead. Looking forward to you joining us along the way.